Hugh, I thought all these banks were going out trying to hire anyone they could get to walk in the door or even log on remotely. What's changed?
Yeah, hey, Contessa, that's actually very accurate. That was a story as of just earlier, this year and last year. So let's set the scene a little bit. 2020 happens, obviously the pandemic. The reaction to that is to unleash trillions of dollars, through the Federal Reserve and take interest rates down to zero. And what did that do? That set off a deluge of IPOs, a deluge of deals, M&A deals, and banks appropriately staffed up. So if you look at the numbers, Contessa, so JP Morgan, which is one of the biggest Wall Street firms out there, added something like 13% to their headcount. Goldman Sachs even more, closer to 17%. Just for those two firms together, you're looking at about 15,000 more bodies, at the Wall Street operations than they were 2 years ago. And so that's the scene we have. And, what's happened this year is interest rates are higher. You've had parts of the capital markets business completely either be very chilly or shut down completely. And you've had a complete, drop off in the level of revenue that they get from IPOs. Now, if you look at the Deal Logic data, it is staggering. There's a 91% drop in U.S. IPOs. If you look at high yield, riskier parts of the debt issuance, that's down something like 75%. M&A is down 30%. So there's no part of the investment banking franchise that has been untouched by this revenue squeeze.
Hugh, 15,000 people, and that was just at the first two firms mentioned. Morgan Stanley proportionally hired even more. Was it too much? I mean, did they just think these trends were going to last forever?
Yeah, this gets back to the nature of Wall Street, which is that it's a boom and bust, it's a feast or famine business. And when it's raining, you have to obviously, try to collect as much of that revenue as possible. And, the people who run Wall Street know the history, and they know very well. They know it's very pro-cyclical, and they still can't do anything to cushion that, because when the deals are coming, you have to have your people, you have to have your boots on the ground. And as a matter of fact, we're talking about, we led with huge layoffs. I tend to think they're going to be more selective. The people I'm talking to are really talking about more in the framework of 5 to 10%. So, these are, Wall Street jargon is RIF, reduction in force. And, they still want, bodies, they still want, people in their seats at the start of 2023, because you don't know if the capital market's going to open up. You don't know if that, that the dam breaks in terms of issuance that's in the pipeline that's been pushed out actually gets to start to happen. So, it's going to be selective, but it will be, broad basis from what I'm hearing. I don't know if it happens this summer, or if which would be very unusual, by the way, or if it happens later in the year in the October, November timeframe. But, the math is very clear. There have to be cuts.
What are you hearing about how they're factoring in the moves that the Fed is making?
Well, so the Fed has, a series of impacts on the trading operation. So as interest rates increase, what's that doing to your risk-weighted assets? If you're a Goldman Sachs or JP Morgan, you might want to have less in risk-weighted assets in trading capital, essentially, for these risky, activities. And bring that down. And so certainly, traders hate that, because then they could make less money. Their P&L goes down. But certainly what you would say is, in a rising interest rate environment, a lot of these businesses are going to be, are going to make less money. And therefore, there's going to be less of a bonus pool to spread around to the bodies that they need to.